In this video, we're going to look at exchange-traded funds, investment trusts, and open-ended investment companies, some similarities, some differences, how to research them, and which might be the best for you to put into your portfolio. This table compares features of investment trusts, open-ended investment companies, and exchange-traded funds. So investment trusts and ETFs are traded on the stock market. Open-ended investment companies are held at their provider. Open-ended investment companies and exchange-traded funds are open-ended. That means that whenever they receive a net inflow of money, they issue more shares and the fund expands. Investment trusts are closed. That means that the portfolio is always intact. And what happens is that investment trust has a net asset value and it can trade at a premium or discount to that net asset value, partly depending on how popular the fund is at that moment in time. OEICs and ETFs always trade at their net asset value. There's a bid-offer spread, which is the difference between the buy and the sell price. For an investment trust, the bid-offer spread can be quite wide, particularly for the smaller investment trusts. For OEICs, there is no bid-offer spread, and for an ETF, there's normally quite a small difference between the buy and sell price. With investment trusts, there is stamp duty at 0.5%. Investment trusts are always actively managed. For OEICs, probably about 80% of them are, and for exchange-traded funds, generally they are passive, so they just track an index. For investment trusts, they can have liquidity issues where if the market is panicking, you might not be able to sell in large quantities. With the OEICs, in theory, there's unlimited liquidity. With just one order, you can buy or sell £1 million worth of Fundsmith. Clearly, what happened with Neil Woodford was that they couldn't actually manage the liquidity requirements, so the fund had to be suspended. But those occurrences are very rare, and exchange-traded funds generally have good liquidity, so you don't have to worry about that. Investment trusts can have unquoted assets, so things like property, maybe commodities, unquoted companies as well. OEICs very rarely, and exchange-traded funds, well, some do track things like gold, but generally they just own quoted companies. So hopefully with this table gives you a good overview of how these different products differ. Open-ended investment companies might have an upfront fee, and it can be as high as 5%. So you need to check your broker's website to see whether you will be charged an upfront fee before investing in one of those funds. Investment trusts might have a performance fee. It's around 25% of cases. These performance fees are a little bit difficult to properly decipher, and they can be quite expensive for things like a hedge fund. The best way to research those is to go to the AIC website, and that explains it in a bit more detail, and I'll show you some links to websites later on in the video. Investment trusts might have gearing. This is where they borrow money to invest, and this tends to flatter the returns, and it's useful when interest rates are low and stock prices are rising, but when interest rates are high and stock prices are falling, it's not so good. So over a whole economic cycle, it's probably marginally positive, but you do have to watch out for that. Investment trusts will have a board of directors. They will have generally stronger governance. There'll be an annual general meeting. You can vote on all kinds of things about how the trust is run. Some of the boards don't really have much teeth, as we saw with Fundsmith Emerging Markets Equity Trust, where it was just wound up without much of a challenge from anyone. But this governance can be useful, and I think it really helps with the longevity of investment trusts. Investment trusts also have a revenue reserve. This means that income they receive from investments can be ring-fenced and it can be paid out at a later date. And this is what helps investment trusts to achieve their dividend hero status, where some of them have been able to increase dividends for 20 years or more in a row because they can tap on this reserve in hard times. So you'll get not just an income, but you'll get a slightly rising income over time. Here we're looking at the performance of an investment trust and an equivalent open-ended investment company. In this case, we're using a couple of funds from Baillie Gifford, Scottish Mortgage and Long-Term Global Growth. So the theory is that investment trusts should outperform OEICs because investment trusts are closed-ended, which means they're not forced to sell any investments at the bottom of a stock market decline. Neither are they forced to buy overpriced assets when there's a stock market boom. Investment trusts can also utilize gearing, and they can buy unquoted companies, and this can potentially boost their returns. They also don't need any cash for short-term redemptions, which can be a drag on fund performance. And in theory, investment trusts have lower marketing costs in terms of dealing with platforms like Hargreaves Lansdown. To offset that, investment trusts do have the costs of a stock market listing and having a board of directors. And from the chart, we can see that it's kind of not so clear cut which one of the two might outperform. In recent days, Scottish Mortgage has underperformed its OEIC equivalent, but there have been times when Scottish Mortgage has outperformed, but then arguably over the majority of the time, the performance has been very similar. This is my attempt at using a Venn diagram to try and explain some of the different holdings of investment trusts, open-ended investment companies, and ETFs. So all three can hold quoted equities and bonds. ETFs tend to specialize, I would argue, more in innovation, particularly around trading algorithms, so they can look at themes and factors and potentially commodities. And then investment trusts specialize in unquoted assets such as private equity, investing directly in infrastructure and property. They're also quite good for multi-asset. So investment trusts are better at the diversification end of the scale. And in a portfolio, clearly you can hold all three types of fund. Here are some examples to go alongside the previous slide. So for ETFs, we've got themes like clean energy, factors like dividend growth. We've got physical gold there as well. For open-ended investment companies, we've got things like Fundsmith and Vanguard Life Strategy. For investment trusts, there's 3i, that's private equity, Scottish Mortgage, bit of a mixture, Pershing Square, hedge fund, Tritax Big Box is kind of infrastructure stroke property, and Capital Gearing is a multi-asset fund. And what's interesting to note is that with Fundsmith, it also has a couple of investment trusts, one looking at smaller companies and one that's now defunct looking at emerging markets. And because these markets weren't so liquid, that's why Fundsmith went down the investment trust and the closed-end route for gaining exposure to them. For investment trusts, you get access to less liquid asset classes such as infrastructure. You can get stable income from the revenue reserve. So you've got the dividend heroes here, great for people in retirement, and they can offer good value relative to net assets if you play the timing game correctly. Some disadvantages are that the net asset value of investment trusts can be subjective, and often the fees are charged off of these arguably inflated net asset values. Some have opaque operating structures. So as we saw with Home REIT, where it's trying to say that it's social housing and the rents are underwritten by the government, actually that was not the case, and there was a whole web of quite complicated flowing of funds for that investment trust. The smaller investment trusts can be illiquid and have a wide bid offer spread, so you have to be really careful that you don't get caught out with that. And often growth equity for investment trusts can have a poor Sharpe ratio, the risk to return rewards. This is because of the net asset value cycle of investment trusts, and they can also have performance fees which will detract from your returns. Here I'm comparing investment trusts to a passive fund. And what you can see is the passive fund is Fidelity World, and it's number 2. And then the only one that beats it is JP Morgan Global Growth and Income. And all the rest struggle to beat it. Some have times they outperform, times they underperform, so they're much more volatile, and others really kind of struggle and have a lot lower performance because they may be more value orientated. So the problem can be with investment trusts is that they don't always beat the market. With open-ended investment companies, there's over 4,000 of them, and this sheer number can mean that they're difficult to research. There can also be some quite unhelpful, fairly clickbaity articles that mention underperforming ones and distract you from where you should really be looking. Also, they're not available on all platforms, and there are some star performers out there with great strategies, and hopefully if you watch the channel, we'll focus on some of these and you can get some great returns. So an advantage of an OEIC is that you can drip feed in small amounts, say like £100 a month into them, because there's no broker's commission, so they're great if you're starting out. Also, you can very easily place large orders with an OEIC. The demerits are, well, there's a delay in trading of 1 day, maybe 2, so the price you're going to get is quite uncertain. They might have an initial fee, and sometimes it feels like you're more like a passenger along for the ride rather than a shareholder. So there's a real danger that the OEIC fund merges or even gets cancelled out altogether and you have no say in it. Also, it's maybe not so good for emerging markets and small cap because these holdings can be less liquid. ETFs can have some amazing multi-factor disciplines around them, things like quality dividend, and over time I think we'll see much better algorithms powering ETFs, and they'll become a really important part of people's portfolios. They're cheaper and there's no fund manager risk compared to things like investment trusts. There's no price to net asset value cycle either. Some ETFs are great in that they list all their holdings and the PE ratio, so you can kind of see when it's cheap, when it's expensive. Some negatives for ETFs are that the thematic ones can really be just based around bubbles, and often these thematic ETFs are launched at the very time when that bubble is about to burst, so the ETF just collapses in price once it's been launched. There can be less price history around some ETFs, so you're not quite sure how well it performs in good times and bad times. And a few ETFs, you have to really research them in quite a lot of detail because they can have some very strange holdings, and you wonder why something like Nvidia is called a quality dividend stock when it hardly has any dividend yield whatsoever. One useful website is pickafund.com. It's got investment trusts, ETFs, and open-ended investment companies in it. I'm going to search for Royal London Global Equity Select, and here it is, and I can see straight away some data on it. I can also look at how many platforms have it, say 9. I can compare it to its peers. I can set alerts on it. I can pull up a bit more details about the fund, talks a bit about objectives of the fund, whether I can put it in a SIP or an ISA, who the manager is. Got some performance here, and this is really important, the 3-year Sharpe ratio, which is the risk adjusted return, and the higher the number there the better. I've got some data on fees as well, what the dividend yield is, so that's all great. Then if I want to compare it to its peers, just takes a while to calculate. So this is a new website. I recommend you check it out because there's all sorts of interesting information here. So here we've got some rankings, 3-year, 5-year, number 1, so that's all very good. And then I've got here, this is just like the top 10 data. So I've got some things I can compare it to, whether they're active, whether they're passive. This is Morgan Stanley Global Brands, so I can just click on here and it'll tell me which brokers have this fund, So that's all really useful, so that I know straight away when I'm doing my research whether my broker will have it or not, because if it doesn't, then there's not much point taking it any further. So another useful thing for Pick a Fund is you can sort of search on categories. So here I'm looking at global equities. I'm going to see all the funds. Just need to wait a little while for it to calculate. And then, right, now I've got it here. Now I'm going to rank on 3-year total return. And here we go. So this one, I mean, I never heard of it, but it says only one platform. Fidelity Fast Global, that's quite an interesting fund. I covered that in a hedge fund video that I did. Then we've got Law Debenture, that's an investment trust. We've got some recovery funds, global opportunities, special situations, Royal London Global Equity. So it's a really useful starting place for looking at funds, what's going on. I mean, some of them don't have any platforms and very low net assets, so you can ignore those straight away. So it's quite good at really focusing you on which funds are available to you. The website that I use for researching investment trusts is the Association of Investment Companies, the AIC.co.uk, and I just use their comparison tools, and I can pull up an investment trust, research on all sorts of things about that trust. I've got details about dividend yield, dividend payments, market cap. I've got the top 10 holdings here. It's got a lot of really useful information all in one place, and it's very easy to navigate, so that's another recommended website. To research ETFs, I use the website justetf.com. It's got a whole load of useful articles about exchange traded funds, what they are and how you can go about selecting them, and then also it's got an ETF screener that I can use to search on the ETFs. So I can select equities, I can select the columns that I want, and then what I can do is then sorting on my data here, and I can pull out the best ones, have a look at them in a bit more detail. So here I can zoom in on Worldwide Healthcare, what's the ticker, I've got a whole load of data on it, what the holdings are. I can pull up the documentation about it, look at the performance chart. So it's a really good website, it's free to use, and it's another one that I recommend. You can also use the website Morningstar to do your analysis and research on ETFs, funds and investment trusts. Here I've pulled up all the gold rated investment trusts according to Morningstar, so I can look at them in a bit more detail and find out maybe whether I want to put them in my portfolio. It is a good website, but it can be a bit confusing to navigate because it's got so many different combinations of funds on it. So my summary is that ETFs can be great for tracking markets, that OEICs, some of them have a fantastic remit, and some of the best performers, things like Royal London Global Equity Select and JP Morgan Income, are the top performing funds, so it's well worth looking at some of the better OEICs. And then investment trusts are great for some of the more specialist areas that they offer access to, things like infrastructure and the dividend heroes, so things like Merchants Trust. So like the video, subscribe and check out this next suggestion.